Welcome back, everyone. My name is Eddie, and this is the Soaring Dividend YouTube channel where we discuss dividends and other passive income investing. In today's episode, we're going to be talking about my top 3 dividend key metrics to analyze before investing in a company. Without further ado, let's get to it. The first dividend metric I'll be talking about today is the consecutive years of dividend growth. This is one of my favorite dividend metrics to look at before I even start investing in a company. This shows reliable companies that continue to pay out their dividends year after year after year. These are companies that you really want to be a part of and that you know are going somewhere. However, just as a precaution, past performance does not always mean future gains and success. So when you invest, don't just look at one metric such as the consecutive years of dividend growth. Look at a whole bundle of metrics, look at their financial statements, and make sure you know the industry and the company that you're investing in will be there long down the road. I'm going to go over some brief key aristocrats and dividend kings. These are going to be my top 3 of each. My top 3 dividend aristocrats, and these are all companies that have 25 to 50 years of dividend payout increases, are PepsiCo, Realty Income, and AT&T. On the other hand, I have my top 3 dividend kings, and these are all huge companies that have huge track records of successful dividend payouts. These are all Coca-Cola, Johnson & Johnson, and Procter & Gamble. 50 plus years of increases is a huge accomplishment, and we should applaud these companies when we can. I have a couple honorable mentions, and one of my favorite companies right now is ticker ABBV. This is a company that I see long down the road, even though they might have some short-term hurdles. The second dividend metric I'll be talking about is the compound annual growth rate, or the dividend CAGR. The dividend CAGR is a commonly used investing term that measures the growth of a company over multiple periods of time. This is often given out in 3 and 5 year intervals. So you'll see a 3-year dividend CAGR and a 5-year dividend CAGR on financial websites and throughout your research. Let's go over a quick example of dividend CAGRs through Seeking Alpha. Let's go to seekingalpha.com, type in Johnson & Johnson's ticker at the top. Let's go down to the dividends tab right here. Scroll down the page and you'll see some of their common metrics. Their 5-year dividend growth rate is at 6.13%, which means that over a 5-year time frame, their dividend payout has increased at an average of 6% annually, which is fantastic. I'm usually more attracted to companies with a CAGR of about 5% or greater, so that I know that they prioritize larger returns to shareholders and they aren't just trying to attract investors by growing their dividends minimally by 1% or so. If you're interested in how this metric is calculated, I'll leave a link in the description explaining it more in depth. Or if you have a question, leave me a comment below and I'll answer you as soon as possible. The dividend CAGR is my favorite metric to look at. When you invest in strong dividend-paying companies, it can be extremely motivating and rewarding to see huge payout increases year after year. Would you rather see a company that increases their dividend at a 15% rate annually and increases by 15 cents or so, or a company that has a 3% dividend CAGR and increases it only by 2 cents? That is up to you, investor, but I like to see a huge CAGR even if it has a little bit lower yield. I am not a financial advisor. This is for entertainment purposes only, and I strongly suggest that you do your own research before you invest in anything. I want you all to succeed and have giant portfolios long down the road. And with a little bit of guidance and some research, you can do just that. The third metric I like to look at whenever I analyze a dividend-paying company is the dividend yield. The dividend yield is the amount of money that shareholders earn for owning a stock. It shows a percentage of the price that is paid back to you as the investor in the form of a cash dividend. Therefore, a higher dividend yield will pay you a larger dividend payout in the future based on how much you spend. Larger yield can be a little bit riskier, however, because as the yield increases and approaches, say, 7 to 10%, then the share price declines. So you have to be aware and you have to know that as the yield increases, share price declines. Let's head over to Seeking Alpha for a quick dividend yield example. Let's take a look at one of my favorite companies right now, which is ENB, or Enbridge Inc. Enbridge is one of the biggest players in the liquid and gas pipeline industry, and they also have a huge field in the natural and renewable energies. So let's go down to the dividends tab here. Scroll down until we get to the dividend yield. This is an average of 7%. And before I even begin on how I view the yield, let's discuss how it's calculated first. So it's calculated by taking the annual payout, which is at 2.63, and dividing it by their current share price, so 37.08. So 2.63 divided by 37.08 gives you the yield of 7.09%. So E&B has a very attractive yield at the moment, which could mean a few different things. If the company remains fundamentally strong long down the road, and by that I mean as long as natural gas and liquid pipelines are needed in the world, then buying at this price would be a no-brainer for me. However, a higher dividend yield like this can also be a red flag since company's share price is also declining. Any yield at the moment above 6 or 7% is on the riskier side for me, but I always look at the future potential of a company rather than just a strong yield. I suggest that you be careful when you invest in these riskier companies and look beyond the yield when making an investing decision. So look at their financials, the amount of debt, their shares outstanding, to truly get a grasp on these companies. Reliable companies can be so much rewarding down the road, and with a little help, we can all be financial ninjas in no time. Those are my top 3 metrics to look at. If you have any other metrics that you think are just as valuable or more valuable, leave them in the comment below. And if you got anything out of this video, please leave me a giant thumbs up and consider subscribing. My future videos will be about my dividend growth portfolio. So we'll actually take an in-depth analysis of the stocks that I own and my strategy. So until then, I'll see you in the next one.